Hi, in this video, I'm going to explain the difference between the monthly and the annual interest rates, as well as the annual interest rate, but with monthly compounding periods. Let's take a look at an example. Let's assume we have a 5% monthly interest rate, and I'm investing $1,000. After 1 month, my interest earned in that month would be 5% of this $1,000, which is equal to $50, and my balance at the end of the first month is going to be $50 plus this $1,000 I had initially, which is going to equal to $1,050. Now, let's take a look at the second month and how much interest and balance I'm going to have at the end of the second month. We're going to have two scenarios here, depending on whether this 5% monthly interest rate is going to be only applied to the initial $1,000 or applied to my updated balance at the end of the first month. If the 5% interest rate is only applied to the initial $1,000, then obviously at the end of the second month, I'm going to have another $50 interest, and my balance is going to be $50 plus my balance at the previous month, which is going to be $1,100. Now, in the second scenario where the 5% interest rate is applied to my updated balance at the end of the first month, my interest earned is going to be slightly different. This time, my interest for the second month is going to be 5% multiplied by this value, my balance at the end of the first month. So 5% of $1,050 is going to be $52.5. And when I add it to my previous balance of $1,050, I'm going to be having $1,102.50. You can see how my balance is slightly different depending on whether the interest rate is only applied to my initial investment amount or it has a rolling in effect and is being applied to my updated balance at the end of each month. Now, a 5% monthly interest rate is equivalent to a 60% annual interest rate because each year has 12 months. So a 5% monthly interest rate is equivalent to 12 times 5%, or in other words, 60% annual interest rate. Now, based on a 60% annual interest rate, my interest earned in 1 year is going to be 60% of $1,000, which is equal to $600, and my balance after 1 year is going to be $1,600, which comes from adding this 600 to my initial $1,000 investment. Now I know what you're thinking right now. You're thinking, what about if I have a 60% annual interest rate, but interest is being paid on a monthly basis? Something similar to this second scenario I explained. So what happens if I have a 60% annual interest rate, but interest is being paid on a monthly basis, and that interest has a rolling effect based on my updated balance at the end of each month? This is the scenario where we call it an annual interest rate, but with monthly compounding periods or cycles. In this case, I'm going to be expecting a higher interest and a higher balance after 1 year. My interest is going to be $795.9, and my balance after 1 year, based on a 60% annual interest rate, but with monthly compounding periods where interest is paid on a monthly basis, and on a monthly basis my balance is updated, then my final balance after 1 year is going to be $1,795.09. Now, how do we calculate this value? How can I quickly calculate this value? Well, we do have a formula for this, which says my future value is equal to my present value multiplied by 1 plus I divided by n power to n. So in this formula, my future value, which I'm after, I'm going to try to calculate this value here, 1,795. My present value is $1,000. That's my initial investment. I is my annual interest rate, which is 60%. But when you want to fill in this formula, you have to go with 0.6, which is equivalent to 60%. And your n is 12 because you have 12 months or 12 compounding periods. Let's go ahead and fill in this formula. It's going to be 1,000 multiplied by 1 plus 0.6. So when you want to insert this 60% into the formula, it's equivalent to 0.6. That's how you incorporate percentage in a formula. Divided by 12, which I said 12 is the number of months or the number of compounding periods you have. This bracket, power to 12, which is going to equal to 1,795, this number right here. To simplify this calculation and to explain what's actually going on, we can actually do this in Excel. So right here, I have a table which shows 12 months. And for each month, at the end of each month, I've noted the interest and my balance at the end of each month. And this is the case where I have a 60% annual interest rate, but with a monthly compounding period. So how can we quickly generate this table and get to this final value in Excel? Let's go ahead and bring up Excel. So I've got a 5% monthly interest rate, or say a 60% annual interest rate, but with monthly interest paid on a monthly basis, and my initial investment value is $1,000. So at the end of the first month, my interest is going to be 5% of that $1,000, which is going to be $50, and my balance is going to be 1,050. Now, based on what I've explained, we can generate the rest of the values here with a very simple formula. So for the second month, my interest is going to be, the amount of interest is going to be my monthly interest rate, which is, when I want to put it in the formula, 0.05 multiplied by the updated value, updated balance at the end of the previous month, which is going to be another 5% of this value. So I click on this one. That's my interest for the second month, and my updated balance is going to be this interest plus my previous balance. We can go ahead, select these two cells and expand it until the end of 12 months. And as you can see, I've quickly generated my interest earned in each month and my balance at the end of each month. And I finally got to that figure of $1,796.